Hello students, welcome to Prudential Business. So students, today in this video tutorial we will be discussing about the second major decision of financial management, that is your investment decision. Okay. So in our previous videos we were discussing about the first major decision of financial management, that is your financing decision. Okay. So under financing decision, a particular company decides who will be the appropriate source of their financier. Okay, either it be by taking a loan from a particular bank, or either by issuing of shares to the general public, which will be called as equity financing. The previous one will be by taking a loan from a bank, that will be called as your debt financing. Okay. So under financing decision, we decided who will be the appropriate sources of our financer, and we got that funds under financing decision. Now under investment decision, we need to decide that particular project or that part of the company where we will be investing those amount of funds so collected. Okay. So here you see, it refers to the careful selection of the assets in which the funds will be invested by the firm after acquiring that funds through the financing decision. Under financing decision, we selected and we got the amount of money. Now under investment decision, we will be selecting the appropriate sources of project of our own company where we will be utilizing or allocating that amount of money. Okay. Next line here you see, it involves investing the funds usually on a long-term basis, not always but usually. That is why this investment decision can be broadly be classified under two categories. Number one is your long-term investment decision. This is also called your capital budgeting decision. Okay. And next is your short-term investment decision. This is also called working capital decision. But usually, as the line suggests, that whenever we talk about investment decision, we usually refer to the capital budgeting decision, which is of a longer period of time. Whenever I say it is a longer period of time, it usually means more than one particular year. Okay. So now here you see, now we will be discussing about the various factors that are affecting this investment decision. In our previous videos, we have also discussed about the various factors that are affecting the financing decision. We also discussed about cost and risk, how it differs from debt and equity in the cases with debt and equity. Now come to the factors or the various activities that a particular company should keep in mind while taking this investment decision. Okay. So the first one is the cash flow of the project. See under the point number one, cash flow of the project, we need to select that particular project that will generate more inflows or will generate more profits than the amount of the return on investment that we will be spending it, or the amount of money that will cause its expenditure. The project will incur some amount of expenditure. Also the project will incur some amount of profits. We need to assess that beforehand. The profits, that is the cash inflows, must be more than the cash outflows. Okay. That is what we have to decide in the first case. Next you say return on investment. Now what is this return on investment? This return on investment is also called rate of return. Okay. Rate of return, which must be always be higher than any other cost of investment. Cost of investment, that will be your expenditures. In case it can be your dividends, or it can be your flotation costs, it can be your any other interest to banks, etc. So whatever that may be, those are included under cost of investment. That cost of investment must be lesser than the amount of profits that it will make. The amount of profits that it will be make can also be called as your return on investment or the rate of return. Okay. Next line here you see, this cost of investment comprises the interest and the principal value. Along with that, other factors, flotation costs also are included in this cost of investment. Next you see, moreover, the return on investment from the project must be higher than any sort of risk-free investment. Now what is the meaning of this risk-free investment? Risk-free investment are those sources of or are those types of investment where there is no elements of risk. Now take for example your multi-option deposits scheme in banks, MODs, or fixed deposits in banks. Whenever you take a fixed deposit in a particular bank, the rate of return on that fixed deposit is certain, and also the period in which you will be getting the entire amount of money, that is also certain. So in that case, whenever you take a fixed deposit in banks, or you shift your money to any MOD accounts or multi-option deposit account, there whatever the amount of money that you will be getting after a particular period of time, that is certain. So there is no concept of risks involved. So the concept of risks will involve where? Whenever you will be investing your money into your business, and business is surrounded by risks. The more the greater the business, the more is the risk. So if you invest in your money in your business, the return that money will generate, that must be sufficiently be more than the amount of the return that fixed deposits or any other types of risk-free investment will give you. Okay, next you see, and must sufficiently cover the premium for taking risks. Premium for taking risks is an extra amount of more amount of money that your project will be greater. Okay, so your project must give you sufficient return than any other sort of simpler or risk-free investment. That is the line written here. Moreover, I repeat the line, moreover the return on investment from the project must be higher than any sort of risk-free investment. That means the amount of money that you will put in or you will invest in your own business, that must be more than any sort of fixed deposits or any other risk-free investment. And that must be more than what? That must be more than the premium for taking risks. Premium for taking risks is the extra amount, is the added amount. Okay, take for example, your project is giving you 10% return, right? 10% rate of return, and the fixed deposits in a bank also gives you 12% rate of return. That extra 2% will be the premium for taking risks, right? So in that case, you are not going to choose to invest in your own project if your premium for taking risks in any risk-free investment is more. The premium for risk-free investment must sufficiently be more in your own project. Your project must give you at least 20% return than if the fixed deposits or any other risk-free investment gives you 10% return, right? I hope this is clear to you. And next is the investment criteria. See, what is an investment criteria? Investment criteria is the investment procedure, how you are going to invest it. There are some mathematical calculations are there. This sort of mathematical calculations, just you can see the evaluation technique, it is shown in here in the arrow mark, like your payback period method, accounting rate of return, net present value method, profitability index, return, internal rate of return, or your accounting rate of return. All those things just requires mathematical calculation. That mathematical calculation is not there in the syllabus of class 12. However, it will be there in your bachelor degree courses like your BBA or BCom. There we will be learning it. But for the present timing of class 12 syllabus, the mathematical calculations of the various evaluation techniques are not there. So we will be confining our discussion only to the theoretical activities. Okay. See, now we are discussing about investment criteria. Investment criteria means investment procedure. How are you going to invest? How are you going to select your own project that will give you more returns than any other sort of risk-free investment? Here you see, this refers to the process of selection of the appropriate funds for its deployment into the business, right? You need to select appropriate process of selection of the appropriate amount of funds, whatever money you got in financing decision, that you need to deploy in your own business. So how are you going to deploy that in your own business? That is the procedure chosen under investment criteria. Okay, so this investment criteria involves a series of steps. This series of steps will be, first one will be your planning, number two will be your evaluation. So what is an evaluation? So under evaluation, all those things, these mathematical calculations will be taken into account. Okay, so after they have passed, after all those things, it is not necessary to do all those calculation, payback period method or accounting rate of return. Some are discounted and some are non-discounted. That will be much higher, so we are not discussing it. So this evaluation process will deliver the best project that will generate more inflows than any sort of outflows in a risky project that you will be investing in your own project. Okay, so that will be the evaluation process. And next will be selection. That means you will be selecting your best sources of project where you will be deploying or investing your funds. And next is the implementation of the funds. Implementation of the funds, you will be executing your own project. You will be starting your own project. And also there is also other steps. You need to control it. Whether controlling means what? Controlling means verifying whether the actual output is according to the planned output or not. If it is not according to the planned output, then you need to reevaluate it. Okay, then you need to again ensure the mathematical calculation in the process of evaluation. Okay, so this is all about the investment decision and also the factors affecting the investment decision.